Thanks for listening to Investor Insights, a behind-the-scenes look at investing with Fund That Flip. This series provides an insider's look at how our business works and answers your frequently asked questions so that you can make better investment decisions with your hard-earned capital. Now, our founder and CEO, Matt Rodak.
Welcome, everyone, to this episode of Fund That Flip's Investor Insights. I'm your host, Matt Rodak, founder and CEO here at Fund That Flip. And as we mentioned on last episode, we just completed a survey of our investors. We got a lot of great feedback, so appreciate all of those you out there that participated. Feedback is a great way for us to kind of continue to improve what we're doing here. And one of the other big things that really stuck out across a lot of the responses was your desire for us to give a little bit more information around some of the deals that we book, how we book them, some more color on the borrowers, the neighborhoods, the markets that we're operating in. So to that extent, I'm super excited to have Jon Andrews joining on this episode. Jon is our Senior Vice President of Sales and Service. He's involved pretty intimately with nearly every loan that we originate and gets to also travel all around and meet with a lot of our borrowers and see the different markets that we operate in. So with that, Jon, welcome to the program.
Thanks for having me, Matt. Appreciate it.
Cool. So before we jump right into kind of dissecting one of the projects that we've chose about, I think would be useful if you could just give everyone a little bit of background on yourself. What were you doing before you joined us? How long have you been with the firm, and kind of what does your day-to-day look like?
Yeah, happy to, Matt. Been with the firm for 3 years and had previously commercial banking background. Was at B of A for the better part of 8 years and was originating commercial loans primarily for healthcare practices, standalone real estate buildings in which those practices would occupy, and those types of deals for B of A. Lived in and worked in geographic markets from the East Coast to the Midwest, specifically out of Philly and out of Chicago, and in Ohio as well. And then joined a alternative lender out in San Francisco, SoFi, that was in the student loan space, and was looking to get into something that had a little bit more of a technology component than where I was at B of A. And ultimately, through a mutual friend, was introduced to Matt and to Fund That Flip. And just resonated with me on a lot of fronts, given my background and kind of the lending space, and with some real estate components there, with kind of what I viewed as the technology that was kind of prevalent, and I think will be more prevalent in all aspects of life, and certainly in lending. And so I was attracted to that and joined the team 3 years ago. And it's been a lot of fun ever since. Day to day, I am spending my time qualifying transactions and deals. We want to make sure that they're the right deal, and then ultimately articulating our value proposition to the borrower as to how we can help them in an effort to earn their business and put a good loan on the books, and be able to then offer that to our investor base to earn a yield and what we believe is a very strong deal.
Got it. Yeah. And as Jon mentioned, he's been with us for 3 years. He was employee number 5 for us. So, and I think I was looking at this statistic the other day. We had done, I think, about 19 loans and I don't know, right around $4 or $5 million of origination. So Jon has been with us and been involved in some form or fashion with every loan since then. So about 98% of our book, Jon has taken a look at. So he probably knows the deals better than anyone else in the company at this point, which I guess is a good thing.
Somebody's got to. So yeah.
Yeah. So again, before we jump into one of these deals, you mentioned the big part of what you're doing and your team there is doing is communicating value proposition to our borrowers, right? So I think it'd be useful to just maybe talk, the listeners who are primarily investors on our platform, what that value proposition is, right? Obviously, guys care about price, right? Interest rate, origination fees, kind of all the other fees that go into it in term. But what are some of the other things that, we found really, really resonate and that, we've tried to build our business and our service offering around?
Yeah, Matt, that's a great question. I think, I think the first answer is it does depend on the borrower. The type of sponsor, the scale at which they operate, the geographic location, the type of projects. I think all of those factor in. But ultimately, it comes down to a couple things. I think the value proposition that we preach is, hey, we'll be flexible. And what we mean by that is we're gonna take the time to understand what you're actually looking to accomplish, and then we're gonna try to flex our loan structure to put us in a place where we're safe but accomplishes what the borrower looks to accomplish. And I think that there's a lot of lenders out there that just say, hey, we do X, whatever X is. Hey, if it appraises, I'll lend you 70% of it and let's go. And they don't take the time to understand what the borrower is looking to accomplish. And maybe it's not just this deal. Maybe it's 2 or 3 deals down the line that the borrower is trying to line up. So I think we do a good job of listening and trying to understand what the borrower needs, and then match our structure to that. And then I think the last 2 things are consistency. They all ask for that. I think every sponsor we have has probably been left high and dry at the table at some point, or scrambling for funds by way of a lender who kind of didn't deliver what they committed to. So our borrowers are hypersensitive to that. And I think that we do a good job and need to continue to do a good job of expressing to them that we're going to deliver for them, and that they can count on us, and that we're reliable and do what we say we're going to do. And we express that to them. And then the last thing I think is speed, is urgency. It is important to them to know that someone is operating with the proper level of urgency, given that this is how they make their living. So they're kind of putting food on the table or not on every deal based on their ability to operate and get it closed and ultimately move through the project. So they're looking for a lender to kind of share that level of urgency with them, alongside of them. And that's what we articulate to them. So the flexibility and understanding of their transaction, the consistency in delivering what we say we're going to deliver. And then the last thing is just speed, letting them know, hey, we will do so quickly. We're going to act in an urgent manner and make sure we're there to deliver. That's really what we harp on consistently with our borrowers. And I think it resonates. I think between those 3 things, one of those is going to be the pain point that borrower is feeling at any given time. And we just try to accentuate that we'll solve that for them.
Yeah. And totally agree with all that. And I think worth pointing out too, is all of those things don't end at the point of origination, right? They extend on through servicing of the loan. And I think borrowers, especially that are doing this a lot, understand that, as important as the service is, getting up to close and closing the loan, as important is maintaining those same levels of speed and transparency and reliability through the servicing of the loan, from, dispersing construction draws and, being there to listen to them as things come up with the project, as they often do, and just maintaining kind of some level of partnership, I guess, if you will, to make sure that they're enabled to be successful.
Absolutely. I think there's a huge difference between, a borrower being, 1 day late on their interest payment, and, maybe there was some life event, or maybe they got held up in travel, or something happened. And knowing that if they've been consistent with their payments prior to that, and they call and they explain, and we can work with them. And I think the flip side being that borrower knows, hey, if I ask Fund That Flip for a construction draw and explain to them, hey, look, I've got a couple projects going on and I need to be a couple places. Anyway, we could rush this and get an inspector out here same day or next day and turn this around. That it's kind of a 2-way street. Hey, Mr. Borrower, if you do the things you told us you were going to do, you execute the project, you pay as agreed, and you're kind of showing us a path to exit, to getting this thing sold or refinanced, whatever the plan calls for. We're going to be inclined to kind of do you those favors of expediting draws and trying to make sure that anything you need, whether it be an extension, if it's appropriate, we handle in a proper fashion from a time frame perspective. So I think that Matt's exactly right. Like we're in it kind of with them for the duration of the project, because ultimately the further we go, the further our capital is extended and over a longer duration of time, we want to make sure we get that capital back. So I think both parties have to be aligned in what they're looking to accomplish between lender and sponsor. And I think we, for the most part, get that right and are able to kind of help them through the course of their term of their loan with us.
Yeah, and I think the reason that this idea of service is so important for those of you that are out there listening, investing on our platform, and I learned this from my insurance days, is there's really kind of 3 ways to win business in kind of a risk transfer business, which is what we're in. The first one is price, right? So you can be the best price and win business. So that's one lever. The second lever is leverage in our business, right? So if we offer higher leverage to our borrowers, we can win new business. The third one is the level of service, right? How responsive are we? How much do we listen? How much can we, help the borrower achieve what they're hoping to achieve? The interesting thing about that triangle is kind of the way that I think of it is the first two, right? Price and leverage impact risk, right? So if we're doing higher leverage, there's more inherent risk, right? If we're pricing lower, you as an investor are getting compensated less for the risk that you're taking, which may not ultimately be any more or less based on that price. The third one, service, is less correlated to actually risk or the compensation that you receive for that risk. So our view kind of building this business has always been like, I'd rather not have to compete on leverage and price, because ultimately those things get passed through to you as our lenders, and there's some trade-offs there. To the extent that we can create value around service and still charge the right, risk-adjusted premium and still structure our loans right from a leverage perspective, our borrowers win because they're still getting, what they're paying for, if you will. And at the same time, we don't have to, do loans that may not be priced right or structured right for our investors. So something that Jon and his team are very tuned into to make sure that, we can still be competitive and win business, but at the same time still offer the right structures and the right, risk-adjusted returns to our investors. So with that, let's dig into a deal. What do you think?
Let's do it.
All right. So we picked for you guys a project close to home here for us in our New York office anyways, in Brooklyn. The project is 1822 Fulton Street, Brooklyn. And what we'll do is we'll post a link to this project on the blog where this podcast is being recorded, so you guys can find it easily. But again, it's 1822 Fulton Street, Brooklyn. It's let's see, what is it? A $1.1 million loan offering a 9% annual return, I think on a 6-month term. So relatively shorter duration loan here. Let's talk first maybe about the sponsor, the borrower, Jon. Give us a little background on who he is, who his team is, and kind of what they're up to in the borough of Brooklyn.
Absolutely. So the sponsor has 3 key team members. So it's himself. It is a partner of his, and then it's their construction manager. So the sponsor and his partner both have a real estate background. The partner was a real estate broker, and the partner was the primary sponsor was a mortgage banker when he initially started his career. So both of them kind of know a little bit about the industry from a lending standpoint. And through the course of their career, they started flipping a home, owning a rental property, got into development. And at this juncture, they've done well over 100 properties in their time together, and countless properties prior to kind of joining forces. And their construction manager has been a member of their team for a number of years and pretty deep background as it relates to building everything from ground up 20 to 50 unit buildings in the tri-state area to the single family home. So we've met with them on a couple occasions, and recently had the opportunity to spend about half a day with them. And we viewed half a dozen projects that they had going on. Everything from true new construction of a 6-unit condo building to a renovation of a single family home. And we were thoroughly impressed with their, I think not the level of work. I think the level of work speaks for itself and was very good. But I think the systems was most impressive. The systems they had in place for kind of managing their crews. At any given time, they're going to have 15 projects going on, potentially more. And they try to stay geographically really focused in Brooklyn. They have occasionally done things in other places. They had mentioned to us a few Bronx projects and even looked at some Staten Island and as you get into more central Long Island over into Queens, and they've done some things there. But they found that operating in Brooklyn, they can really concentrate on kind of knowing it street by street, block by block. Even had the opportunity to meet the pastor at the church across the street. And I asked them how he knew that gentleman. They said, well, he owns the 2 lots on either side of the church and they're selling those to us. So they've kind of got they've got their knee deep in all things Brooklyn in the area where they operate. So I think that gives us a great level of comfort with how well they know the neighborhood, and looking at their track record of completed projects in the vicinity. You could almost build an entire comp set off of just units that they have transacted. So was really impressed with kind of the depth of their background.
Yeah. So, and maybe I'll take a step back, right? So we kind of think about, when we underwrite all of our projects, kind of in three different buckets, right? The first is execution risk. The second is project risk. And then the third is what kind of I call liquidity risk, right? So a lot of what has to do with execution risk is our borrower or team that makes up our borrower, which is what we're talking about here, right? These principals have tons of experience. They're super entrenched in the markets that they operate in, have a lot of lines into opportunities, whether it be, buying land or buying properties. And I think that's a very key component to any real estate business, right? Is being able to buy right? And these guys, I think, have been operating in Brooklyn and kind of, I guess, a couple of the boroughs for was it 20 plus years now?
20 years.
20 years. So they know their markets well. They've obviously been doing it as long as they have. They've found some success. And I think, as John said too, like something that we always look for is systems, right? How are you buying properties? Do you have systems around that so that you're getting consistent deal flow? And we have some belief that, the deal flow you're getting is good deal flow. And that comes from just getting a lot of looks at a lot of different properties. And then what systems do you have in place for managing the construction piece? And then similarly on the back end, what systems do you have in place for marketing these properties and ultimately getting, the best price that you can and moving them as quickly as you can as well. So fair to say these guys got all of those boxes checked.
That's correct. Yeah, I would say that they check all of the boxes of the things we look at and care about. They had a really strong kind of answer and perspective and story to share with us across the board.
Got it. And I think the other thing interesting specifically about this project, again, 1822 Fulton, is it's primarily a residential unit, right? I think there's 2 units on the second and third floor. And then on the first floor, the street level, it's actually their offices, right? Like that's where we were at. What was that, a couple of weeks ago?
That's correct. So they had over time the first floor of this building had been utilized as a storefront and then was vacant, and above was residential. So the sponsor actually acquired this building over 3 years ago, and as part of his portfolio had just kind of sat on it and waited for the neighborhood to transition. And it's north of Atlantic Avenue there in Brooklyn, and as the cool factor of Brooklyn continues to push east, and more people have a desire to buy and to live there, he saw an opportunity to take that building to kind of highest and best use, rehab the residential components of it, and as he was spending time in the first floor, started to set up kind of an ad hoc office in there, and was doing some calls and taking some meetings from there. And found it to be a very successful location. So they went ahead and did a renovation of the first floor. And the neat thing there, don't know if you recall, Matt, but all of the woodwork in there was repurposed out of homes that they had owned and done rehabs on, and they had pulled it out and refinished it. Even the construction manager is kind of a little side project. The hobby of his is building furniture, and so it was all Brooklyn sourced distressed wood out of their previous properties that they had built the office furniture out of there on the first floor. So it was just kind of cool. And I think fits the neighborhood well from the standpoint of like what's there, the look of the building that they've done. And I think the product that they're bringing to the marketplace made a lot of sense with what they've done with this project. So kind of a unique aspect there.
Yep. Yeah, I was gonna mention that. Glad you did. And we got some photos of that again on the project site. You can see the desks that were built, as well as the beams that are more decorative, kind of up above, is all reclaimed wood from previous projects. So I think speaks to the level of detail and care that these guys are putting into the work that they're doing, which we always like. So let's talk a little bit about project risk. So execution risk is kind of who's running the project, and do we believe in their capabilities of buying right, managing through the construction, and then getting us to an exit. But then we're also looking at, right, the individual project. And a big piece of this is valuation, right? So what's the property worth in its current condition when we're initially originating the loan? What does the rehab budget look like and how's value being created? And then on the back end, once we get the project to highest and best use, or what we call after renovated value, what's our value going to be? So maybe just talk us through a little bit of, how we typically break down these kind of different parts of the valuation exercise, and then specifically, how we came up to the numbers that we came up with on this one.
Certainly. So the first thing that's going to happen when we're looking at a file is our analyst team is going to look at, they're going to use our software, which is very much what an appraiser would use. It's pulling a lot of data from the MLS and from public record for that specific geography. And they're going to get a determination of what that building is worth today. And we do that just like any other kind of comparable analysis would be run. We take a great deal of pride in knowing that our analysts do a good job of not only matching up, bed and bath count and square footage, but looking at unique traits of the building. Does it have a rooftop deck? Does it have off-street parking? Does it have covered parking? And finding like properties. Those things I mentioned might be more applicable in a more urban and denser setting than suburb setting. But either way, like the example holds true. We want to understand, what is unique about the property, and then try to build our comp set around other properties that share those like characteristics. And then the next step would be we dive into the scope of work. So we look at the statement of work the borrower provides. What are they looking to do? Where are they looking to allocate their dollars in that project? And then try to make a determination around, okay, if this kitchen is completely renovated and you now have a gas stove and stainless steel appliances that would be in line with what the buyer demands today, what kind of value creation is that? And so again, we work through the same comparable analysis exercise. We just go find properties that would check the boxes in line with what our property is going to look like when it's complete. So we use that software, and then the next thing that we do is we order a third-party appraisal. Sometimes we order an inspection, a construction inspection in conjunction with that. But what we're looking to do is get some data points from the property itself, from somebody on site that's arm's length from the firm, a third party that provides us those data points. And when that comes back, our team kind of does a side-by-side analysis of that inspection report and valuation report compared to what we had. And we're looking for discrepancies there, not only in the end valuation, but in, the measurement of the square footage, the bed and bath count, the room count. We just want to make sure that everything that we knew to be true is true, and match it up to that document, whether it be appraisal or inspection. So that's kind of on a deal-by-deal basis how we work through that process.
So yeah, we're looking at a lot of data. We're getting access to a lot of the real-time data that an appraiser or anybody else that's really in the business of putting values on properties, our team has access to that. But yeah, a very important thing is, as Jon mentioned, is we do get boots on ground to all of the projects before we finance them, whether that be a third-party appraiser or some type of an inspector, because we like to see from a third party what's the condition of the property, and it helps us align photos with the statement of work to make sure that we're accounting for everything that's going to need to be repaired or updated or modified in order to get the highest and best use. So yeah, so maybe let's talk about on our site, right? Oftentimes we're going to give in the valuation section, we're going to give really three kind of LTVs, right? We're going to give an LTV based on the purchase price. We're going to give an LTV based on the appraised ARV, and then we're going to give an LTV on the FTF valuation. Maybe just talk us through kind of what those three things are and how they're sometimes different.
So the LTV on the purchase price is going to be what represents our loan the minute it goes out the door against the purchase price, and we're making the assumption that the purchase price is representative of the current value of the property. If there's discrepancy there, we note it and we make the proper adjustment. Typically that means coming up or down on that disbursement amount. In relation to what the true value of the property is if it's not aligned with the purchase price. But most often it's aligned with the purchase price. So if the purchase price, is $1.5 million and we're lending $1 million against it, we're 66% advanced or 67% advanced against the initial value. So like we'll note that for the lenders on our platform, and then we're looking at the LTV against the finished product.
So before you go there, John, just so everyone's clear, right? So like on this example, right, we've got it's not a great example because this project's already complete, but let's just say it's a $1.1 million loan. We're typically not advancing that full $1.1 million to the borrower upon origination. We're holding some percentage of that loan back for the construction portion of the loan. So what we like to tell you as an investor is how much went out the door on day one relative to the current value of that property. And that's going to give you your purchase price LTV or as is LTV so that you can understand, all right, day one, what kind of equity or what kind of cushion is there, if you will, above our money out on the project versus its current condition if no work were to happen or if no value creation were to happen.
That's correct. And I think a nice segue, Matt, into the second version, which you had mentioned was like the FTF, the Fund That Flip ARV. So we'll arrive at that number from our analysis and in conjunction with some third-party data points. And then what we'll do is we'll break out what the total loan amount would be, assuming those construction funds are advanced against the end value. And the same methodology applies there. We want to make sure that we've got a proper level of cushion of equity above us. And as the borrower creates value during the course of the project, as they conduct their renovation, the construction money comes behind that. So in theory, as the borrower is creating equity, he's drawing on our construction funds, and we're kind of moving in unison to a place where you get a finished product with an end value of X, and we're still somewhere in that neighborhood of 65 to 70% of that number, so that we know that the remaining risk of the project will be just getting it sold, getting it dispositioned to be able to repay the loan, and even in that end state when all of our construction funds are drawn down, we should have a level of cushion above us in the project in that end value. So we present that on our deal analysis as well for the lenders on our platform to take a look at, so they see the initial loan to ARV against the purchase price, to Matt's point, kind of day one, what's out the door against what it's worth, and then they see the end value version of that as well on the analysis tool.
Yep. So maybe talk to us a little bit about like typical percentages that we're trying to stay within, right? So you mentioned kind of 65 to 70% of after renovated value on an LTV basis. Again, this one in Brooklyn, we're on the higher end of that at kind of closer to 70%. When and why would we go a little bit higher on those as opposed to sticking to where we're a lot more comfortable in the 65% range?
Yeah, I think we just have to be. I think we have to be smart, Matt. And what I mean by that is, for this particular deal that we're talking about, the 1822 Fulton, we've got a borrower with a robust track record. We've got a borrower who's got a credit score representative of prime of A paper, right? He's a almost 800 credit score kind of borrower. He's shown us his financials, related to liquidity and kind of the movement of cash flows in his real estate business, to give us a great deal of comfort that he can execute, and that he's, able to go source, he could go get different capital if he needed to, whether that means tapping into his bank line or even a home equity line. Like, he's got options in a pinch. That gives us some comfort. And then, the last thing is the asset itself. In this particular case, the asset's complete, or nearing completion as he's kind of picking things off of the punch list. So we feel like there's a little bit less risk in the project there, in that we're not going to open up a wall and find something out, because he's already done that in this case. So in that case, would we be willing to be a little bit more aggressive with leverage? Yes, I think it's warranted, and I think it makes sense. And I think it's also what the customer needs in this case. So that's why we'd make that decision. So to your point earlier, you had spoke about the levers pool to win business in price and in leverage. And, same kind of thing I think applies when we're originating the loan on the front end. let's make sure the leverage is appropriate. And if a customer wants kind of lower pricing, like the leverage would come down. So, we want to be 60 to 70% of the end value. We want our loan to value, our LTV, to end up being 60 to 70% of the end value of the asset when it's done. And the other metric we're paying attention to, Matt, is cost. We want to know that our loan to cost metric is responsible and is kind of in line with what's expected in the industry, and appropriate kind of risk rated return for our lenders. We want to have an 80% give or take loan to cost calculation for a borrower. So we want to know that between the downstroke on the acquisition of the building and on the construction budget, that they've got somewhere in the neighborhood of 20% of true costs into the project. And it again speaks to alignment. We want to know that they've got skin in the game alongside of us. That's what's going to get us comfortable helping them scale beyond just the one project, and kind of helping them truly scale their business a couple projects. Is that alignment and their kind of investment in the project alongside of us.
Yeah. So really what you're talking about, right, is what we call compensating factors, right? So if we're going to go higher on something like loan to after renovated value, we should get something in return for that, right? Whether it's price, whether it's a really strong asset, whether it's a really strong borrower. In this case, I think we have a lot of those things, right? We've got a strong borrower, which we've talked about. And you mentioned something I think it's really worth pointing out, is the loan to cost on this particular project is about 66.8%, meaning that, our borrower has still about $500,000 tied up into this project that they can really only recover by, either refinancing our loan out or selling the property for its value. So it's one of the things that we look at. And I think it gets to John's point earlier around, really listening to our borrowers' needs and being flexible and understanding what they're trying to accomplish, as opposed to just saying, does it fit into this box or not? Oftentimes we can creatively structure a deal that helps the borrower get what they need, but still offers enough compensating factors to make sure that we're protecting the other side of our business, which is our lenders. So yeah, something to look at, right? It's not just LTVs always. I think the LTVs are a very good place to start, but making sure you're honing in on things like loan to cost and the borrower profile are internally things that we're paying close attention to as well. So that kind of maybe, and we'll start to wrap this up here with kind of the third bucket of risk that I mentioned, right? So the execution risk is our borrower. The project risk is really what's going on with the project. And then liquidity risk or kind of how do we get paid back, right? Like we got to understand, is the strategy to sell this property? Is a strategy to refinance it? If it is to sell it, what is the inventory is looking like? How long is it taking things to sell? How liquid of a market is it, right? Is this kind of a unicorn property that, has a very small number of buyers, or is it kind of right down the fairway and there's a lot of different types of people that could potentially buy this property. And then on the other side, if it's a refinance, we're counting on our operator to be able to get refinancing, whether that's bank financing or another non-bank lender. So maybe just talk us through about maybe we can just specifically talk about this project. What is these guys' plan for taking us out, especially given that the term of the loan is 6-month loan?
Yes, Matt, we stepped into this loan as the borrower said he had owned this and was kind of taking it to a highest and best use and wanted to put leverage on it as he has some other projects kind of in the works. So it was a way for him to help him kind of scale up a couple projects at a certain time. So he's going to end up refinancing this building with a traditional lender. He'll operate his office in the first floor and kind of as the leasing office for some of the rental portfolio that he holds there in the neighborhood. And then the 2 units above him will be rental units. I think at the same time, like any shrewd investor, it's always for sale. And he told us this. He said, any building you want. He said, you right price, I'll sell it. So I think that as that neighborhood continues to heat up and demand continues to push east, kind of down Atlantic Ave, I think that there is probably the very real possibility, and maybe it's not inside of our 6-month term, but whether it's inside of our 6-month term or over the course of the next couple of years, I think that borrower ends up selling that asset to someone who's willing to kind of pay market value or a premium as the neighborhood continues to kind of have more and more people doing these renovations. In this particular case, I think as we drove around those few blocks, Matt, there was there had to be maybe 15 or 20 projects just like this kind of underway. So I think that as that becomes more the norm there, he probably gets to a place where the sale makes sense.
Yep. It's in a great location, close to several subway stops, and is definitely, in an area that is gaining more and more interest as the city kind of continues to push out. So for sure. Very cool. I think I'm gonna bring us home here. So appreciate you sharing all this, John. I think useful for those of you that are listening. Again, check out the project so you can see more specifically what we're talking about. We'll drop a link here at the bottom of this blog posting. John, if people want to get a hold of you or reach out to you, what's the best way to do so? Maybe just drop your email address.
Email address is Jon, Jon, at funthatflip.com. So it's John with no H, Jon at funthatflip.com. Be happy to address any questions that anybody has.
Yeah, so if you'd like to, feel free to reach out to John. If you're a borrower listening and have a project, definitely reach out to John. Those of you that are lenders, appreciate you listening. Always welcoming feedback. So if you have any ideas on what we can be doing better, please shoot those over to investorrelations@funthatflip.com. We'll be doing more of these with John and different members of his team, diving a little bit deeper into some additional projects as we're funding them. So be sure to check back in the next couple weeks or so to learn more about some of the specifics of these projects that are available to finance on the platform. Otherwise, also check out our blog. We've got a lot of content going out around how to be thinking about investing on the platform, as well as some other pictures of projects that we've recently funded and a number of different things. So be sure to check out the blog. Otherwise, really appreciate you guys listening. And until next time, this is Matt signing off.